Hello and welcome to Omni Deep Dive. We explore any topic from finance and technology to literature and science. Sit back, focus, and get ready to dive deep.
Welcome back to the Deep Dive. Today we're jumping straight into what looks like a fascinating paradox, using your sources on BlackRock's iShares Core Allocation ETFs. We're talking about AOK, AOM, AOR, and AOA. And, when you first look at these, they promise the ultimate investing shortcut. It's the one ETF to rule them all.
Right.
You get a globally diversified portfolio. It's tailored to your risk tolerance. You just pick one, conservative, moderate, aggressive, and you're done. So our mission today is really to test that promise. Is the simplicity on the surface matched by simplicity underneath, or is this a really complex machine disguised as an easy button?
That's the core question, isn't it? For the investor, yes, they're simple to buy. But our dive shows that the methodology behind them is, well, it's intense. We're going to unpack the exact mechanics of these target risk funds, explore the rigorous risk management tools under the hood, and, expose some of the high-risk assets they're bundling up.
And before we get into the weeds, there's one key detail from your material that really sets the tone for me. BlackRock formally changed the names of these funds on February 19, 2025.
They now reflect the precise internal asset allocation. So the aggressive fund, AOA, is now the iShares Core 80/20 Aggressive Allocation ETF. The most conservative, AOK, is the 30/70.
And that name change is so key. It immediately confirms the fixed percentages. You get what you paid for, 30% equity, 70% fixed income, or 80/20. That's the promise.
Which, leads me to the big question. When I see these clean splits, like 60% equity and 40% fixed income for AOR, for the balanced one, I just wonder, is modern finance really that simple? Because BlackRock just stick to those percentages, rebalance once a year, and that's it. The end of the story.
It's the beautiful illusion of the product. The static split is the investor-facing truth, but the underlying methodology is anything but static.
How so?
These ETFs, they track the S&P target risk indices, and these indices are dynamically optimized annually. They're not just rebalanced to hit that 80/20 split. They're adjusted to reflect the current market landscape.
Okay, let's just nail down those targets first so everyone knows exactly what they're choosing between. Absolutely. So you got 4 risk profiles. The most defensive is conservative, AOK. That's 30% equity, 70% fixed income.
Right.
Then the middle ground, moderate or AOM, 40% equity, 60% fixed income. Then you move up to the growth-focused one, balanced, AOR, 60% equity, 40% fixed income.
And the big one.
And finally, yes, the capital-seeking aggressive, AOA, 80% equity, 20% fixed income.
So we have the ratio. Now, about that optimization, you said they're actively managing something. What are they optimizing against? Why isn't 80/20 just 80/20?
They're managing against something called shortfall risk. This is where the engineering really shines. Shortfall risk is a very specific measure of downside risk.
Okay, what does that mean?
It's defined as the probability of the index attaining returns below a preset risk threshold over a given period.
Wait, you're saying they literally bake a maximum acceptable loss probability into the design?
They do. Each index level has a specific risk threshold. For the conservative index, they're tracking the probability of returns falling below -6%.
And for
the aggressive index, they accept a threshold of -15%. The goal of the optimization is pretty simple, actually. Maximize the fund's beta, its correlation with the market, while staying below a maximum allowable shortfall risk.
Okay, let me try to put that in real-world terms. If I'm buying AOA, the aggressive one, I'm signing up for a fund that is engineered to have an 80/20 split, but that split is dynamically adjusted to make sure the fund's risk of losing, say, 15% in a year never goes above a certain probability, like 18% in the aggressive case.
Precisely. That's the subtlety. If the market gets too risky, the composition might shift slightly just to keep that shortfall probability under control.
See, that's why beta matters, even if you're just buying one fund.
Exactly. Equity beta, as your sources define it, measures your fund's tendency to move with the entire market, usually against the S&P 500.
Okay, but simplify that for me. Why should I, the set-it-and-forget-it investor, care if my beta is 0.8 or 1.2?
Because it tells you how rough the ride will be. If your fund's beta is 0.8, well, when the S&P 500 drops 10%, your fund is engineered to only drop about 8%.
And if it's higher?
If your beta is higher, say 1.1, your fund is designed to amplify the market moves. It could drop 11% when the S&P drops 10%. This is the practical result of managing those risk objectives.
So conservative funds want a low beta, aggressive funds want a higher one.
You've got it.
That makes so much sense. So the 80-20 split isn't just about diversification. It's about controlling the magnitude of market swings. It's a sophisticated risk machine, not just a simple pile of stocks and bonds.
Absolutely. Now, let's look inside that machine. How do they actually build these things?
Right. What are the actual pieces? We know they're funds of funds.
Correct. The core structure is that these allocation ETFs are made up exclusively of 7 specific, very liquid iShares ETFs. This is how they get that global diversification and scale.
So 7 funds to create the one fund I bought. What are these building blocks?
Okay, so we have 5 in the equity basket and 2 for fixed income. The equity part is pretty comprehensive. You've got the iShares Core S&P 500, the S&P Mid Cap, the S&P Small Cap.
For the whole U.S. market.
A whole U.S. market cap spectrum, plus the iShares Core MSCI Emerging Markets and the International Developed Markets ETFs. So it's global. And for fixed income, the focus is on broad global bonds. The iShares Core Universal USD Bond ETF and the iShares Core International Aggregate Bond ETF.
And the sources break down that fixed income split, which is, it's heavily weighted to the U.S. bond market.
Very much so. An overwhelming 85% of the total fixed income allocation goes to the U.S.-focused bond ETF. Only 15% is allocated to the international one.
And that explains the geographic bias we see. I was looking at the sources. The aggressive fund, AOA, is about 64% invested in the United States. But AOK, the conservative one, is nearly 70% U.S.
It is.
For a global index series, that's a huge home country bias.
It's significant, yes, but it reflects a common investment preference. And even with that U.S. dominance, these funds are globally diversified. If you look at AOA's top holdings after the U.S., you see Japan, China, the U.K., Canada, France. The whole trust has to follow those strict 1940 Act rules on diversification. So no more than 5% of assets in a single issuer. It gives you that broad market exposure.
Diversification, check. But let's get into the hidden risks. The risks that the word core might mask. If I see core allocation, I assume, low drama investing. But the underlying parts, they suggest the exact opposite, especially in fixed income.
This is maybe the most crucial part of the deep dive. The simplicity ends where the underlying holdings begin. When you buy those bond funds, you are inheriting all of their inherent risks, including exposure to non-investment grade or high-yield corporate bonds.
Wait a minute, junk bond.
The infamous junk bond.
Inside my core 3070 conservative allocation ETF, that completely changes the risk perception for someone looking for low volatility.
It does. These are corporate bonds, rated below BAT3 by Moody's or BBB by S&P. They're considered speculative. They come with a much higher risk of default and extreme price swings if the issuer gets into trouble.
It's a hidden volatility engine.
It is, designed to juice the yield, but it carries a real penalty if markets freeze up.
Yeah?
And it gets deeper. The underlying funds also use derivatives.
Okay.
Specifically, futures contracts and options on futures. And while they say they use them to manage costs, the source material highlights 2 major risks.
What are they?
First, the risk of loss in trading futures can be really large because of low margin deposits. You're highly leveraged.
And second,
and this is the really chilling part, the potential for loss related to writing call options is, and I'm quoting, theoretically unlimited.
unlimited loss potential, bundled into my simple one-stop fund. That is not what I think of when I hear the word core.
It's definitely counterintuitive, and that's just the fixed income side. Now think about the emerging markets exposure.
Right, which is an explicit part of the equity side.
Exactly. Emerging markets are just inherently more unstable. You have political interference, less liquid markets, government limits on foreign investment, and specifically, let's talk about China. It's a major component.
The sources mention the VIE structures, variable interest entities. Can you explain why that is such a massive hidden structural risk?
Okay, think of it this way. When you buy a share of standard U.S. company, you own a piece of that company. You have equity. With many Chinese firms listed on U.S. exchanges using this VIE structure, you don't actually own the company's equity directly. You own a contract, a variable interest entity, that just gives you economic exposure to the company's profits.
So I own a piece of paper that promises me returns, but I have no actual ownership rights.
Precisely. If the Chinese government decides to intervene, or if local partners breach that contract, the enforceability is highly uncertain. You could suffer a huge loss with very little legal recourse. It's a fundamental break from traditional equity ownership. And even when you invest in China's domestic A shares through something like Stock Connect, the custody risks are unique. Investors don't hold the securities directly.
So who does?
A nominee holder. Trading can be suspended easily, and your rights as the beneficial owner are not clearly defined under Chinese law.
So the one-stop simplicity of AOA is achieved by bundling three major complexity bombs: high-yield junk bonds, derivatives with potentially unlimited downside, and this really volatile contract-based exposure to politically sensitive emerging markets.
It absolutely is.
The risk tolerance defined by that 80-20 split is just, it's so much more layered than a beginner investor would ever realize.
It is. And the complexity doesn't stop with the assets. It extends to the operational plumbing of the ETF itself.
The creation unit mechanism. Explain why that matters to the average person who's just buying 100 shares through their broker.
It matters because it defines liquidity. When you, the retail investor, buy a share, you're buying it on the secondary market at a market price. That price might be a bit higher or lower than the net asset value, the NAV.
And I can't sell it back to the fund.
Your individual shares are not redeemable directly from the fund. Only massive institutional players, they're called authorized participants, can deal directly with the fund. They create or redeem these huge blocks, creation units. We're talking 50,000 shares at a time. You rely entirely on them to keep the secondary market liquid and the price close to NAV.
So it's institutional plumbing that keeps the retail market flowing. And speaking of institutions, the sources highlight conflicts of interest within BlackRock itself.
They do. We see two distinct conflict issues. First is the allocation conflict. BlackRock, or BFA, manages these ETFs, but it also manages thousands of other client accounts.
So what happens if there's a hot stock everyone wants?
Exactly. If a desirable security is in limited supply, BlackRock allocates the purchase or sale on a basis it deems equitable.
Which means?
The source material is very clear. This system may adversely affect the size or price of the assets purchased or sold for a fund, meaning your ETF could potentially be disadvantaged in favor of another BlackRock client.
And the second conflict is about how these shares are sold, right? The fees paid to advisors.
Correct. The fee conflict. BlackRock pays compensation, its revenue sharing, to intermediaries and broker-dealers like Charles Schwab and Fidelity to promote the sale of shares.
And the source material actually says?
It explicitly says this payment may create the incentive for the intermediary to encourage customers to buy shares.
So your advisor might be pushed to recommend the fund not just because it's good, but because of BlackRock's payment structure.
That is the potential conflict at the distribution level, yes. BlackRock covers most operating costs, but those payments introduce a clear layer of complexity and potential bias.
Okay, let's zoom out. Our deep dive reveals that these core allocation ETFs achieve their simple, tailored market exposure through some pretty sophisticated index optimization, using things like shortfall risk. But that simplicity is really just a wrapper for a bundle of high-risk elements: junk bonds, potentially unlimited derivative loss, and these complex international custody structures like VIEs.
It's efficiency achieved through an aggregation of complexity. And of course, we always have to remember the fund documents core warnings. Diversification and asset allocation models do not guarantee performance or protect against loss.
Absolutely. But let's end on a truly provocative thought, something that affects every investor but is, I think, rarely considered. When you buy this simple one-stop fund, you are not just delegating investment selection.
No.
You are delegating your shareholder voice.
That's the hidden layer of responsibility in passive investing. The ultimate control over the underlying stocks, covering everything from board independence and executive pay to climate strategy, is all executed by BlackRock Investment Stewardship, or BIS.
And how specific are their governance guidelines? Are we talking general principle?
Oh, no, they are extremely specific. Your sources highlight that BIS outlines criteria like alignment with TCFD and ISSB standards and detailed decarbonization goals aimed at limiting global average temperature rise to 1.5 degrees Celsius.
And if a company doesn't meet those goals?
When a company falls short of these criteria, BIS may vote against the directors.
So if I buy the simple AOA fund just to get market exposure, I am simultaneously giving BlackRock the explicit right to vote my share against the board of a major energy company if that company isn't meeting BlackRock's specific forward-looking climate strategy goals.
That's precisely what you're delegating. You've accepted their investment strategy and you've accepted their specific global governance agenda, which is highly active in areas like climate and social stewardship.
I just wonder how many people buying that easy symbol ETF realize they're also making such a profound global governance commitment. It's definitely something to think about. What is the true price of portfolio simplicity when it means delegating your vote?
Indeed. It's a decision that goes far beyond just your financial returns.
That's all the time we have for this deep dive. Thank you for joining us, and we'll catch you next time.
That wraps up this Omni Deep Dive episode. Thank you for listening. If you found value in today's deep dive, please click like and subscribe to our channel. Take care.